Growth and income opportunities this week include a bank and a REIT, and we're going to find out more about each now with Todd Bunton, our growth and income stock strategist. So the bank is Wells Fargo. That's a very recognizable name.
Yeah, over $230 billion market cap.
Wow.
They're one of the biggest, I like to say they're one of the best run too big to fail banks. And they actually just delivered a very solid second quarter on July 12th. If you take a look, it was an all-around good quarter for Wells Fargo. They saw growth in loans, deposits, their credit quality improved. They saw expanded net interest income. Very solid momentum here. And if you take a look at estimates off that beat, analysts have been raising them pretty considerably for this year and next. Now, the two biggest factors of the Zacks rank are the agreement and magnitude of analyst estimates.
Yes, they are.
And you can see those are moving in the right direction. Over the last just within the last week, after the beat, a majority of analysts have risen their estimates for this year and next, like I said, and that drove consensus considerably higher for both this year and next year. So solid earnings momentum here. It's a Zacks rank of 2, which is a buy rating. So you've got good earnings momentum, pretty good growth story. If you look at consensus estimates, analysts expect low double digit to high single digit earnings per share growth over the next couple of years. Not a tremendous growth story, but very solid, stable income as long as the economy continues to slowly improve. And very shareholder friendly company. They pay a dividend that yields 2.8%. That's one of the best among the big banks. And if you look, their payout ratio is right around 30%. So that's the portion of earnings they pay out to shareholders in the form of dividends. Now, historically, of course, this is pre-Great Recession. They were up more around the 50% rank. So if you get, I'd say as long as earnings continue to improve, you can expect that payout ratio to increase.
Really?
And, yeah.
It's going to be interesting.
Yeah. And now they do have stricter capital requirements than they did, before the Great Recession. So that might temper growth and might temper growth in dividends too. But I still expect solid dividend increases from Wells over the next couple of years. So look for that. And you're getting all this at a pretty reasonable price. They trade about 11 times forward earnings, discount to their historical median of 14 times, about 1.5 times book value. Historically, they're at 2.1 times. So it is a discount to that. Could be strong total return potential in this name. Not a name that's probably going to double over the next 6 months, but a very solid growth and income play here, I think.
All right. Talk to us about National Health Investors. That's the REIT that you wanted everyone to know about.
Yeah, obviously you can tell by their name they're focused on healthcare, and more so on long-term care. They actually provide financing to the operators of mostly assisted living facilities and skilled nursing facilities like nursing homes.
I was wondering where the real estate connection came.
Yeah, so they don't actually operate those facilities themselves. They just basically lease them to the people that run them. And in some cases, the companies that run them will sell the property to NHI, and they will go around and lease it back to them in a long-term lease. And you think, why would a company do that? Well, it frees up capital for the companies, and they can focus on what they do best, which is running these facilities.
Sure.
But obviously, this area is a growing area. If you look, 10,000 people are turning 65 every day. The demographics of this country are shifting more towards the elderly. So there's definitely some growth here, and also some defense as well. It's kind of not quite recession-proof. It depends on if these facilities have Medicare backing them or not. But definitely less cyclical than some other names out there. So you've got growth and defense, and if you take a look, very solid earnings momentum. They delivered 3 consecutive positive earnings surprises. Analysts have consistently risen their estimates over the last 60 days, and I brought with me the agreement and magnitude for NHI. You see both moving in the right direction. If you look at consensus estimates, analysts expect low double-digit funds from operation growth this year, high single-digit growth next year. So good, solid, stable growth story. Very good income as well. As a REIT, they have to pay out at least 90% of their earnings in the form of dividends to avoid paying tax on that money. So they pay a dividend that yields 4.6%. And if you take a look, since 2003, they've increased their dividend at a compound annual rate of 6%. So as long as
pretty good.
As long as that funds from operation continues to grow, expect that dividend to continue to grow. And you're getting all that at a fair price, I'd say. They trade about 17 times forward earnings. Historically, they're at about 15 times. So it is a slight premium to that. But the stock price has pulled back considerably. So it is a lot cheaper than it was just a few weeks ago. So I could be getting in at a decent price here for, if you have a long-term focus. Could be solid total return potential here as well.
And why were you smirking when you talked about that turning 65 part? I'm just
Oh,
curious.
no, that wasn't a smirk, no.
Do you own either of these?
I do not.
All right, check out other stock picks on our website, Zacks.com. If you're not there already, it's very easy. Just go there on the internet, and you'll see stock picks for your consideration that you can link to right off the home page. With Todd, I'm Terry Ruffalo.